So the question now we have to ask ourselves is, how do we gauge movement? How do we gauge price movement, and how to do it specifically based upon a few criteria. One, I want you to consider pre-trade, pre-entry. We might have an entry price based upon our chart pattern analysis that puts our entry, say, 10 pips away from the trigger for us getting into a trade, whatever your order entry was. That might be 110 pips if it's a longer term time frame. The matter at hand is, how many pips does price have to travel to actually trigger your entry? Now, when we're looking at something like this, what we have in front of us, the broader stroke of each hour broken down into potential pip movement, this can certainly give us some idea of what the likelihood is for that entry within the hour that we're looking for. So, for example, if you're looking at an entry 8 a.m., this is a fairly volatile hour. You know that on average we could be looking somewhere between about 33 to 35 pips. On the upper end it's over 50, and on the lower end it's below 20. We already know that we can gauge our expectations based upon potential known and unknown economic forces, scheduled releases, unscheduled events, the natural increase in volatility that occurs with the open of the New York session. Okay, so we know those are effects. But how do we gauge that specific to our time frame? So that's the next step. So I know overall within this hour this is the potential for movement. How do we go to the next step? And that is when we break it down, again dissecting that hour based upon the time frame that we're looking at. So if you ever read, and hopefully you do, the Daily Trading Edge or any analysis that I do, you'll know that I'm very specific about time frame. It's not enough to say I'm looking at the euro US dollar. To me, that's only half the picture. I'm going to be very specific about which time frame I'm actually looking at, because consider the ramifications of the time frame. When you've sat down and looked at the 15 versus the 30 versus the 1 hour, 4 hour daily, even a 5-minute chart or even a weekly chart, you may know once you apply the 34 period exponential moving average on the high, low, and close, my 34 EMA wave, and you've done your market cycle analysis, you know that the 15-minute chart can be in a very different market cycle than the 30, then the 1 hour, then the 4 hour. The 15 could be in some sort of transition, the 30-minute could be in a trend, the 1 hour could be in a stronger trend, the 4 hour could be in a downtrend. I mean, we could have very different looks at psychology based upon the time frame. That's one consideration. The second is the type of movement we're liable to see during the next 15 minutes, during the next 30 minutes, during the next hour. I kind of liken it to a foot race. If we were all to line up at the same spot and I said, go ahead, travel as far as you can for the next 15 minutes, I told another group, go ahead and travel as far as you can for the next 1 hour. Unless somebody trips and falls, chances are the group in the 1 hour group is going to travel further. We can equate that to price range. Given more time, the price range will likely be a wider range. Now, I wanted to pick this time purposefully because this is 11:45 a.m. and there's a reason I chose this particular time. Because if we had been looking at 8 a.m. Eastern Standard Time, 9, 10, even 11 a.m., even just 45 minutes ago, it's likely that our price movement ranges would have really shown a much more dramatic shift or a much more dramatic difference from the 15 to the 1 hour to the 4 hour. So what I wanted to again bring home is a lesson that I hope all of you remember, which is understanding when and when not to trade, or understanding more specifically what your expectations for price movement should be. As we approach 12 o'clock, we've talked about trading times, we've talked about financial centers. Let me refresh your memory. Starting with Sydney as the fresh new look at the day, moving into Tokyo, Hong Kong, and Singapore. That is the Asian session that's really going to be seen here in terms of price movement between about 18 and 19, which is 6 and 7 p.m. Eastern Standard Time, rolling all the way into 4 a.m. when the Asian session is basically done for the day. So as we have the overlap that begins around 2 a.m. with Frankfurt joining the party, with London joining the party, what we want to realize is our pip movement expectation must reflect, of course, which financial centers are open and overlapping. So what happens after noon Eastern Standard Time, this 12 bar right here? Well, it starts, you can see the drop-off, which is in part due to the fact that the last typical scheduled economic release for a day is usually sometime between 10 a.m. and the effect could even last going into 10:15, maybe even 10:30. But at 11 o'clock, it's basically 5 p.m. in Frankfurt. And so as you see this drop, this reflects 5 p.m. in Frankfurt. And let's face it, most people do work an 8 to 5 type day no matter where they are in the world. So as this drops with the Frankfurt close, as this drops again with noon and the London close, we enter the doldrums. And this is what you see reflected on this chart. The doldrums. Notice how the range difference between 15 and even the 1 hour isn't all that great any longer. This has to be done in respect to the time of day. So as you're nearing noon, and even getting into what I call the doldrums, between noon Eastern Standard Time and about 6 p.m., before Sydney opens, you're going to see that pip movement is really going to, on all your time frames, except for probably your 1 hour, which is still going to be wide, but less volatile than we would have seen at, say, 8 or 9 a.m. as far as expectancy. You're going to see everything is going to basically narrow. So if you're managing a trade, you now know where there could be support and resistance on each one of the time frames. But if you're considering entering a trade, what I want you to factor in is what I feel 12 to 6 o'clock does is like float around like a leaf in the breeze. Prices tend to wander. Now we do have 2 p.m. economic reports, 2:15 obviously FOMC, so Beige Book, FOMC, the minutes. There are events that will happen in the afternoon. 3 p.m. is the bond close, the last hour of the equities trading day. 4 p.m. is the end of the equities trading day. Again, all Eastern Standard Time. So there are events that will affect volatility that could turn into some movement at those hours in the Forex market. Don't forget what the dollar and the Dow mean to many of our Forex pairs. Think about those correlations. But for the most part, we're going to see the doldrums affect price movement to the point where the volatility will tend to dry up. Why is that? Between 12 and 6, basically the only financial center active and open is the U.S., is New York. One of my rules of thumb is that there must be 2 of the major financial centers open for me to enter a trade, to enter a new position. I'll manage a trade any 24 hours, any part of the 24-hour day. But as far as entering a new position, I'm very leery about the hours between 12 and 6. Typically, the only exception to that are yen-related pairs, cross rates, and say the dollar-yen. Because with the yen's carry trade and with the yen's relationship back to equities, I find that between 12 and 6 is a little bit more viable. But again, I typically won't. So just keep that in mind as you enter the doldrums. I really wanted to stress that point here. You can dissect this information, that 1 hour, into expectations for your time frames. Know that the longer time frames are typically going to come with more risk and more reward, and the shorter time frames will be less. Understand that on your chart, this will become very real in terms of the actionable support and resistance levels that we might see.